Hi, everyone. Welcome to the Capital Raisers Show, Season 5, powered by the Family Office Club. I'm your new host, Weston Walker, where we interview only the best investment managers and entrepreneurs. We have an advisor on today that advises GPs, LPs, and we'll get into that later. Shout out our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Today we have Aleksey Chernobelskiy. He is an LP passive investment advisor. He also helps GPs as well, which we'll talk about. And he was previously the senior vice president at Store Capital, a public REIT where he led a 20-person investment team and ran a $10 billion portfolio. He was a quadruple major here at the University of Arizona. Aleksey, welcome to the show.
Thank you, Weston. It's good to be here.
Of course. Yeah, so let's get into the types of people that you help. And you help LPs, GPs. Today we're going to be speaking to the GPs, how they can structure their offerings to best serve limited partners.
Sure. The vast majority of my clients are LPs. I speak directly to them on either future investments that they're thinking about making or existing investments that have some sort of decision to be made or some sort of hiccup. With some advisory work that I do for GPs as well, but again, the vast majority are on the LP side.
Sure. Yeah, so what are the top tips you have for general partners to structure their offerings so that they best serve the limited partners and the alignment of interests are there?
Sure. Also, I guess starting with alignment of interest, I think there's a few different things we can speak through, but what I tell LPs is to think about investments with three different pillars. So the first one is execution, which is sort of like the background of the GP, right? The second one is the one that you touched on, which is alignment of interest. And the third one is sort of the property itself, if we're speaking about property level syndications. Within the alignment of interest pillar, there's really three topics to discuss. One is the co-invest, another one is the waterfall, and the other one is the pref. And the way that I try to explain this to LPs is that all three of them are interlinked. What does that mean? That means that if I, for example, tell you, and I hear the opposite of this all the time, people call me and say, hey, I'm so excited about this deal, it has a 10% pref, right? And my response to that always is, that doesn't mean anything to me until you tell me the other two variables, right? In other words, you can't I guess you can't judge this indication by one of these variables or by its cover, right? And the same thing is true for the GP side, right? So on the GP side, I often see GPs, I think mistakenly, I don't think people do it on purpose, but they actually don't put in those three variables or factors into their investment decks. And so it's actually unclear to the LP what dollar amount or percentage they're co-investing, what the pref on the deal is, and what the split is between the GP and the LP once that pref is met. Another thing I'll just throw in here, this is sort of like it should be so obvious that it shouldn't even need mentioning, but you'd be surprised how many counterexamples I've seen, is just the need of return of capital. Like, return of capital should, and I say this all the time without embarrassment, like if LPs see deals without a return of capital clause, they should just walk away and maybe not even talk to the GP again. I think, I know that sounds strong, but like I've seen people get, I guess, let's say, taken advantage of.
How often do you see that?
Not often. I would say 5% of the deals I see. It's not a lot, but it's 5% more than I would expect. It's something so obvious you would think that, like, usually there's two types of waterfalls, right? Like, one has a pref come first, then a return of capital, and another one has a return of capital come first, pref come second. Both of those are fine, but my point is, like, the return of capital should be there. It shouldn't
Definitely.
be that you're just like going straight into the split after the pref.
For sure. Yeah, talk about how waterfalls should be structured in different types of investment offerings. Some people do buy and holds, some people do value adds, and then you also have early stage managers and late stage managers who the late stage, they have a track record, they might be able to charge higher splits. So talk about that for a moment.
Yeah, so let me touch on splits and fees in general as well. I think it's sort of a similar topic. Alignment of interest is very fee heavy conversation too, which is sort of another topic I speak about. So I think it's important for GPs to understand what they're trying to do, right? Are they trying to, is the goal to syndicate a few deals, right? And then you're sort of on to some other business? Or is the goal to sort of build a big portfolio over time, and attract a lot of different investors? I would say the vast majority of people are trying to do B, right? They're not trying to do a few deals and get out, so to speak. And so I would say, um, the generally speaking, and I'll share a counterexample to this in a second, but generally speaking, the better economics you give to LPs, and the less fees you have, right? As a result, the more LPs will sort of flock to you, and you'll have more capital to invest. Now, this assumes that you can actually find a good place to put it, right? But the LPs will sort of come to you because they recognize that you have better economics. Where of course this hits a wall, so to speak, is at the end of the day, this is a marketplace. There's no rule as to what the split should be, right? There's no rules. There's no guidelines. Nothing is illegal. I mean, unless you're doing something against securities laws or lying or whatnot, right? And so therefore, if I'm a GP and my goal is to only do one deal a year, that's good. And I already have enough LPs that are interested at what I would call, generally speaking, a pretty aggressive split or 50-50, right? I'm leaving out some other variables here, but let's keep it at that. Then it's like, well, that's okay. Meaning if enough LPs are interested in your deal at 50-50, then you should keep it at 50-50, right? But my responsibility, at least, when I would advise an LP on such a deal, is to explain to them a normal split is like 75-25, maybe 80-20. Nowadays, that's much more normal. And then the question with the LP is, do other factors within the deal, do the fees, pref, is there anything in there that sort of offsets the fact that you're giving up so much of your upside?
Sure. Yeah, and talk about the mistakes that you see GPs make when they're raising capital from limited partners, pitch decks. You kind of touched on it before, but let's go more into the mistakes that they make.
Yeah, I would recommend people to check out an article called Minimum Viable Deck. I guess people can Google Minimum Viable Deck LP lessons. There I quite literally go through what I would consider to be a minimum viable deck. In terms of the biggest mistakes, Weston, I probably see a deck a week that doesn't have an address. I see a deck a week that is missing some very basic information, like who the GP is. You'd be shocked to hear that, maybe. I see probably half of the decks that I see do not explain the full list of sort of fees that are involved, the co-invest, the waterfall, the pref, just the basic economics, right? And I'm not talking about giving definitions, right? I'm just talking about here's what you're signing up for, right? And here's how a relationship is governed. I see a lot of people not disclose other parties in the deal, which almost always comes back to bite them. In other words, if they're not the GP, but they're some sort of intermediary or a capital raiser, nothing wrong with that, but that should be disclosed. And I can tell you on the flip side, I see many LPs that think that they invested with the ultimate decision maker, but they're actually invested in some sort of SPV that's in between them. And I'm not sure how else to say this, but those realizations are never positive.
Yeah, talk about the like it's called a fund of funds model. I mean, a lot of people invest through those, and a lot of managers, I know three personally that have the fund of funds structure. They have 50, 60 people raising capital for them. Do you think that's a good thing for this industry?
Loaded question. I think I think there are aspects of it that are is good. Meaning, I think there's a place for fund of funds and what I would call feeder funds. Um, and the question is always, how are they monetized, right? This is what I tell LPs. Like, if I'm an LP, there's no problem if I'm being pitched by a intermediary, but the question is um, how are they compensated? You many times, to be clear, that compensation comes up front, and or on the back end. Sometimes it's an and, right? It's both, and there's no real risk to this intermediary for getting an investor in, right? In other words, there's some reputational risk, of course, but they're also not hooked on the loan, right? Like there's it's a different profile than the GP itself, because the intermediary can be like, well, we got you into a good deal, but the GP messed up, like right when things go wrong. But so the question becomes, okay, so traditionally a feeder fund and a fund of funds would get you into deals that you otherwise couldn't get into yourself, right? This gets us into, I guess, two different topics. Number one, what's a LP investment that makes sense, right? I tend to go around the $100,000 number, and I have like very lengthy reasons for that. I think many people would disagree with me and say, even $5,000 is good. I can tell you that a lot of the capital raisers do say that publicly. And the second question that it gets into is, if you buy into this model, so what are you paying for, right? Meaning, if you can go directly to the GP and invest the same $5,000, so what did you pay for? Presumably, the answer is they did really good diligence, right? And many times publicly, that's what they'll tell you. Like, we looked at 100 deals, and this was our favorite one. The problem is, I think many times, there's like pretty heavy bias behind the scenes. The reason why they chose that one deal out of the 100 isn't necessarily because it's the best for you. Sometimes it's the best. It's the best one for them economically behind the scenes. They got the biggest share of the promote. They got the biggest percentage dollars, as part of the investment up front. So without understanding all that, I think it's difficult, Weston. I think there's a place for this, but perhaps I would go and say that it got a little bit out of control. I think I would
Just
say
have
that,
to be skeptical.
directionally. I think there's definitely a place for these types of intermediary vehicles, but I guess in my opinion, perhaps it got taken a little too far.
Sure. Yeah, and you see people raising capital that have never done a real estate deal before, and they start pitching deals that they don't have a track record investing at all. And obviously, you have to build up your track record, and you can leverage someone else's as well. But just have to be skeptical in that way. So yeah, you work with a lot of individual syndicated deals with these operators. What are your thoughts between syndications and funds?
Yeah, sure. I mean, I'll walk through them briefly. The big benefit, I think, with a syndication, an asset level syndication, is you get into a deal and you get to see it before buying into it, right? While a fund is typically fairly blind. Like you're sort of trusting the GP a lot more to make investment decisions. And I would say 9 times out of 10, you have no control over what they buy. Again, whereas with single asset syndication, it's right in front of you. You can analyze it. You can ask questions, right? So I think a fund necessitates a high level of diligence, meaning that the execution pillar, which is the first one, needs to be a lot more comfortable for a fund because you're sort of there's some blind trust involved. The flip side, of course, is if the fund is done right, you benefit from diversification. Like sometimes A GP has the exact thesis on a great market, is very honest, has the right structure, fees, alignment, everything. He even bought the right thing. But I don't know, a fire happened or something, and it just didn't work out, right? And if you're sitting in a fund, that those types of issues tend to get diversified away a little bit. Whereas if you're in a single asset syndication, it's just like, it's a fairly binary outcome.
Which do you prefer personally?
Um, I mean, if I'm investing my money, I would probably look a lot more about single asset ones, if that's what you're asking. I mean, I think it depends on your level of wealth too, a little bit. If you're looking for diversification, you can go into funds, but I think in many situations it would be difficult to get to that level of sort of execution trust without having to, done a few deals with them round trip on a single asset deal.
Sure. Yeah, a lot of investors, do 5, 6 deals syndication before they move into the fund model. A lot of operators have both. So let's talk a little bit about from the limited partner standpoint. How should they start analyzing deals, and what should they prioritize when they're looking at 10, 20 deals at a time?
Um, yeah, so I guess let me back up. I think you said something great, which is 10, 20 deals at a time. I think most LPs actually don't look at 10, 20 deals at a time. Most LPs will randomly get a deal while they're, sitting in their dentist office and they're on lunch. And they're like, oh, I don't know, like passive income, this sounds great. And they just wire the check. That I mean, you'd be surprised, but that is representative of probably 50% of retail investments, more or less. Um, it's like, I think based on trust to a fault, generally speaking, the LP is not so sophisticated in terms of what questions to ask. The reason why I started there is seeing 10 to 20 deals at a time is actually very valuable, because you're able to like look at a ton of deals and start comparing them to one another in terms of fees, and you start to understand what market looks like, right? But I think many LPs actually don't get to this stage, and that's I'm creating like a GP-LP matching platform for this exact reason, so that LPs can have access to really as many deals as they want, in a sense, and then they pick and choose and reach out to the GP if they're interested. Um, in terms of what to look out for once you see it, I mean, I put together something I call top 15 syndication mistakes. I think you can Google it pretty easily. The thing that I would tell people to do is avoid sort of like red flags investing, right? Which is very common among LPs. I'll give you an example. You open, you open the second slide, and it says 5% pref, and you're like, and I get these calls all the time, Weston, like every day almost. It's like, I can't believe these guys are raising money at 5% pref. What is going on in this world? And I'm like, well, did you look at the co-invest? And they're like, oh no, it's 50%. I'm like, oh, that's a lot. Like, maybe they can get away with that because 50% co-invest is not normal. Did you look at the split? Oh, it's 90-10. Oh, interesting. Okay. That's also not normal, right? And so, meaning, what I'm trying to get LPs away from is this sort of like gut reaction to a single metric, because that's just not how investing works, right? You have to understand the landscape. You have to understand like what the track record looks like, what the property looks like, and then really with exercise and doing this a lot of times across many deals, you start getting a much better gut instinct for, is this really interesting as a whole or not?
Sure. Yeah, and so you have the sponsor, you have the deal, obviously. Do you advise LPs to underwrite their own deals? Maybe they don't have a lot of experience, and like how should they vet the underwriting of the deal with not a lot of experience?
Um, well, two things. First, I don't get to underwriting until the third step, and I would say a solid half actually don't make it there. Um, in other words, the first step is execution, track record. Do you trust these people? Are there lawsuits outstanding that are important? How is their existing portfolio performing, etc., etc. The second one, as we talked about, is alignment of interests, fees, waterfalls, prefs, right? Um, co-invest. And then the third one is, okay, interesting. Okay, so we have like a decently experienced sponsor, or perhaps an inexperienced sponsor, but a very good alignment of interest, right? Like those two could offset each other to some degree. And then you get to the property, and that's when you do the underwriting, right? So what I'm trying to say is that's the last step I get to. And some people are surprised, but I think it's important to remember that you're not necessarily investing in a property, you're investing in a person who happens to be operating a property.
Yeah, exactly.
In terms of what to look for, look, I think the first thing to do is just to like understand the pro forma, understand the margins. Many times the margins don't make sense. Many times syndicators will underwrite to margins that they've never achieved in the past on dozens of deals in some cases. I think a lot of other things, like other income is a tricky category. Like, turning on income for cable, for Wi-Fi, for water, for utilities, trash, like all these things. It works, but to a point, and I would say generally speaking, it's overstated, right? So, another thing is rents. I think, I'm sure you can relate to this, but I think in 2023, LPs for the first time started like Googling cash in refi, because they all of a sudden got an email that says like there's a cash in refi, and they're like, what do you mean? I thought like, did you mean to say cash out refi? Because they didn't understand like that was a possibility. So I think the next phase of this, which is probably 2026 ish, is people trying to Google gain on lease, right? It's pretty common to understand like, hey, like there's some rent embedded in here that we can find, right, when we buy the property and get a new tenant, which is called loss on lease. But gain on lease, I think, is a topic that a lot of people don't understand yet, and it's like it's out there in the wild today, all the time. Like a lease, and just I guess for the listener, like just because you have $1,000 in rent today, doesn't mean that when the lease rolls, i.e., expires, and you release it, doesn't mean that it might not drop to 900. Like in Phoenix, for example, some rents are down. Austin, down like 20-25% in some cases, right? So your rent, like your gross rents, are actually dropping after expiration.
Sure. Yeah. And I think, underwriting, a lot of deals don't get there, like you said, 50%, which is crazy. And sponsor investing with people are the most important. So you mentioned track record, you mentioned outstanding lawsuits and other things with the sponsor. What are the top qualities you look for in the best operators that, make it, possibly to your deal platform and that you personally invest in?
Yeah, sure. So, to be clear, on the platform, the filtering happens on its own, meaning I don't filter anything. If the LP wants to see sponsors with a 10-year track record and 80-20 split with an 8% pref or better, that's all they're going to see, right? So meaning the platform is filtered by the LPs, not me. In terms of what to look for, I think the most important thing is just transparency and honesty. It sounds cliche, but it's actually not so common. Um, I see a lot of decks with what I would call you can either call it confusing language or perhaps in some cases I think it's I don't want to call it like lying, but perhaps like deceptive language in terms of how they describe their existing portfolio, um, previous returns. There's all types of stuff. Previous experience. I mean, you have people listing like their $50,000 LP position as a previous deal that they owned, and it's not false, but it's also similar to me saying like I own Tesla because I own a share of it, right? Right. So there's a lot of stuff like that, and ultimately, look, at the end of the day, I think what sets the best sponsors apart is during difficult times they respond with the truth. They are honest about what's happening. Um, they communicate on time, and so a lot of this is unraveling now because a lot of I guess not as great sponsors are having a hard time in those categories.
Sure. Yeah, and you talked about how valuable it is to have multiple deals that you're looking at as a limited partner. So how can limited partners increase their deal flow? Say they want to look at 20 or 30 deals. How should they find these operators to get on their deal list and things like that?
Yeah, so I guess this question, Weston, is actually like the biggest reason why I'm creating this platform because I don't think there's a good way to do it. And I'll tell you what previously I've been asked this 100 times, and I think the answer is something like this. You can Google, right? You can Google like real estate syndicator Phoenix, real estate syndicator Seattle, whatever, right? Um, and some stuff will come up, like maybe 2% who happen to be like, ranked on Google for whatever reason. You can also like start looking at podcasts. That's another route. You can also look at, the Crowd Street, Yield Street, of those guys of the world, Realty Mogul, right? And all of that is great. It's a great place to start. But the problem is like you're basically fishing for deals, and you're not even sure there are deals, right? Meaning you're not even sure that GP has a deal for you to invest in, right? And even if that person slash GP has a deal that you're invested in, that you're interested in, looking at, it might not meet your criteria, And so I guess that's where my whole idea came from is like, it shouldn't be that difficult for me to get an email. Like, on the one hand, there's like a lot of GPs that are looking for money, and they'll be glad to have more generally, right? There's another side of LPs that are like, well, I really want some specific type of deal and I just can't find it. It's hard for me to find, and I don't want to spend the time looking for it. And so that's where the platform comes in. Ideally, someone logs in and they say, listen, I live in Seattle and I would like to see Seattle deals only that are only industrial by a GP with a 5-year track record and 100 million AUM, and the check size is 500,000 or more, right? And like all of those things are preset, and if those filters are met, you simply just get an email, right? So the LP is happy because they don't have to do all this sort of let's call it research up front, and the GP is happy because they potentially have a new lead.
Mm-hmm. Yeah, and what's your plan with that? Is it like fee based? The LP pays to get on the platform, or is it from the GP side?
So I'm not sure yet. I'm like 3 weeks, I guess maybe 4 weeks in. I'm starting with it being free on both sides, and kind of taking the cost of development and API stuff. I have a lot of ideas of like how to monetize, but I'm really not sure like where I'm gonna go with it yet. The bigger question to you, Weston, is whether this succeeds at scale or not. Like
Sure.
hypothetically, it sounds great. But I think once you reach scale, things either become really awesome or are not so awesome. And so first I want to check. First I want to check which one it is.
Sure. Yeah, and talk about your newsletter a little bit. You have a paid newsletter. You post on social media. Obviously, you give free value. But talk about what what the value that you provide there.
Yeah, sure. I mean the newsletter is lplessons.co. There's 6,000 investors on there. I started writing, I guess, maybe 14, 15 months ago. Um, there's like over 100 articles at this point in the index, which people can find, um, on topics ranging from, a bunch of the things that we just spoke about now to diligence, to like asset specific types of posts, to how to how to review a capital call, how to figure out if your deal is distressed, all types of topics. And so I write once a week. I write like a paid post once a week, which you have to pay to access. But once a week, I also write a free post, um, that you do not have to pay to access. And the vast majority of the users are actually on there for free, because they, I think, enjoy the Friday post, which is a digest of different interesting topics that I've seen throughout the week on LinkedIn, Twitter, the news, wherever it was.
Hmm. Gotcha. So you have the newsletter, and how do you work with limited partners exclusively? Like, if someone wants to work with you one on one, how does that look?
Yeah, super simple. I mean, they just reach out. I understand what they need, make sure that I can help them. And then it's either a flat fee or an hourly fee, depending on sort of like the engagement type.
Sure. Yeah, and just mention your contact info. We can link it in the description as well as your newsletter and things of that nature.
Yeah, for sure. So again, the newsletter is lplessons.co. The email is my first name, Aleksey, at centriocapital.com, and Centrio is spelled Cantrio, centriocapital.com. Anyone can reach out at any time. And I'm like super accessible on LinkedIn and Twitter as well.
Awesome. Well, thank you for coming on, Alexi.
Thank you. Thank you. It was great. I appreciate your time.